Nick Parsons of the Thomas Llyods Group. He's joining us on the show. Nick, sorry to keep you waiting, but just give us a sense of how the outlook now for India. Has the outlook changed at all post the announcements made on Friday? Has India started to look that much more attractive?
Well, good morning from London. I think India does look more attractive. Investors were getting somewhat frustrated, somewhat unnerved by the lack of any real policy announcements since the election. We saw that being reflected in the external value of the rupee. We'd also seen that through some underperformance of local equity markets. It's worth bearing in mind that even after the sharp rally that we've seen on Friday and today, that both the Sensex and the Nifty are still down for the quarter. We're here in the last week of Q3 and the performance numbers are still in the red. So it's rescued the quarter, but it's certainly not really been enough to completely turn around the losses that we've seen over the course of the last 11 or 12 weeks. So the outlook has improved, and I think the fourth quarter bodes well. But for the moment, it's just about rescuing what previously had been a pretty dismal set of numbers.
Sure, get your point, but this is probably, the foundation that has been laid out with regards to the upcoming future and for many years to come. So from, a destination attractiveness point of view for foreign investors to put their money in, it matches the corporate rates in China. Probably it's better than the corporate rates in Brazil. In Singapore, obviously, is 17% so we're not there yet. But the attractiveness increases, and therefore, do you expect more flows to come in?
Well, yes, is the simple answer to that question. And please don't misunderstand, I'm very optimistic about the medium-term prospects for Indian investment and the Indian economy. And I think the measures that were announced on Friday are a coherent package which is most certainly going to improve investor sentiment. I think, though, we also have to look at whether we're talking about financial assets or real assets. Now, we at Thomas Llyods are an investor in real assets. We own assets in renewable energy, in the solar space. And it is still the case that the actual physical purchase of rupees and the exchange controls that are in place do make India somewhat more complicated to invest in than some of the other jurisdictions. Now, you mentioned comparisons with Singapore. We could look at the Philippines. We could look at other countries that don't have exchange controls on foreign direct investment in the same way that India does. And I think really to get FDI flows into the real economy, really where the government and the authorities would like them to be, I think there is a case for making the whole process of attracting FDI and the physical transfer of money and funds and buying rupees, that should be made somewhat easier than it currently is, because believe me, it's not currently straightforward. So yes, it improves the outlook immediately for financial assets. I think bond markets have sold off too much locally, and I think that the yields that are available are going to prove very attractive to international financial investors. But to real money investors and FDI flows, it would be really nice to see the package supplemented by some measures towards liberalising the foreign exchange regime.
Hi Nick, so this move definitely puts India at par with a couple of other countries in the Asian region, but so far, as you also highlighted, India was underperforming the emerging markets, and if I look at the returns, MSCI India, of course, it's turned positive now, but it's still underperforming the EM basket. So within that basket now, Nick, where does India feature? Will after Friday's move, will it feature somewhere higher, or the place remains the same right now? Additional flows is something, of course, we're watching out for, but will this attract more of investment from the emerging market basket as well?
Well, I think it is likely to. If we look at the quarter as a whole, there are 24 EM currencies. And if we look at the league table of performance against the US dollar, in this third quarter of the year, India is 13th. So it's a solid mid-table performer. The good news is that the rupee is now down at 70.8, having breached 72 in the early part of August. So we are seeing a little bit of currency strength returning. I think some of that underperformance that we saw through July and August is going to be reversed. I think, though, that the rupee is not really going to attract a lot more flows until it can show some solid and positive momentum. And for that to take place, we probably need to see a break of 70. If dollar rupee breaks below 70, then I think you would get a lot of momentum players coming in, as well as the people who are just chasing yield. So the bad news story, the negative news story, is probably over. I think the period of underperformance is perhaps behind us, but we just need to see some consolidation and perhaps even a move psychologically onto a 69 big figure for dollar rupee before you see investors take a much more positive stance on it. So that for me is the bellwether. Have a look at the currency. It's a solid mid-table performer so far in Q3, but if it is going to do well, then I think a move into the 60s is going to be necessary to attract more of the momentum type flows.
Nick, before we thank you, in the announcement which came on Friday from our finance minister also for setting up new manufacturing facilities, the rates were lowered for that as well. So in light of all of that and ongoing trade war issues between US and China, companies now who are looking to leave China, do you think India stands to gain with that move?
Yes, I think it does. So far we've seen a concentration on countries such as Cambodia, on Bangladesh and others that are geographically perhaps closer to China. But I think it certainly does help. But as I stressed earlier on in our interview, it's one thing to lower the tax rates, it's another to say that we're open for business, it's another one to make comparisons with other countries in the region. But it would be really, really good to see some movement on foreign exchange liberalisation, because after all, you can't invest in manufacturing industry unless you can actually get hold of the currency, and that is still going to be one of the biggest barriers, the non-trade and non-tariff barriers, if you like, that foreign investors still face. So let's hope for some good news on that in the future.